Good afternoon, everyone. My name is Betsy Mayotte. I am the president and founder of the Plymouth-based nonprofit called the Institute of Student Loan Advisors. Thank you for joining us today. We are recording the session so it can be viewed by other Cape Cod residents in the future. This afternoon's presentation is specifically regarding the details and the differences between student loan consolidation and refinancing. We chose to address this topic because it's a topic that we get a lot of questions on from student loan borrowers, and it's one where there tends to be a lot of confusion. This is probably, well, for certain, the shortest of the series of webinars that we're offering through the generous sponsorship of the Cape Cod Foundation and through our partnership with Mass Hire for Cape and the Islands. Before we get into the material, I wanted to tell you a little bit more about our organization. The Institute of Student Loan Advisors was founded in 2017. Our mission, our whole reason for being, is to ensure that all consumers have access to free, expert, and neutral student loan advice. So anyone can utilize our website. We don't require a login. We don't require that you share any personal information. If you have questions, beyond what's on the website, which I would like to think, and our goal is to make sure that that's presented in plain English. You can email us through the contact page of our site. We answer all questions, or 99.9% of them, within a business day. And it could be anything student loan related, whether it be how to choose a repayment plan, whether or not you should consolidate, all the way through if you feel like you have a dispute regarding your student loans. So our website is right there, freestudentloanadvice.org. So let's dive right in. So within the student loan industry, the words consolidation and refinancing mean very specific things. Outside of the student loan industry, the terms are often used interchangeably. But again, within the student loan industry, these two words mean very specific things. If you use the word consolidation, we are almost certainly talking about federal student loans only. When we use the word refinance, we're talking about private student loans only. And part of the reason for that is because you cannot, quote unquote, refinance your federal loans within the federal program. Refinancing generally means that you're not only changing the term and possibly who the lender is of your loan, but that hopefully you're also getting what would be a better interest rate on the loan. Consolidation for federal student loans, as you'll see in a minute, the interest rate doesn't change. It's not something that you can negotiate, and it's not something that's based on, say, your credit score. Consolidation in the federal student loan program is literally just putting all your loans together under a single loan. So let's go over the two. So for consolidation for federal student loans, what you're doing is you're paying off your individual loans and creating one great big new loan. And that new loan is going to have a longer term. So the typical term for a federal student loan is 10 years or less if the balance is very low. On a consolidation loan, the term is going to be between 12 and 30 years, depending on what the balance of the loan is. Now, the interest rate on a federal loan consolidation is the weighted average of the interest rate of the loans that you're consolidating, and then they round up to the nearest eighth of a point. So back of the napkin, you essentially end up with the same interest rate that you had before. Now, the interest rate on a consolidation loan is always a fixed interest rate. And back in the early, this a myth that sort of floats around student loan consumers that everybody should consolidate. And where that myth comes from is up until 2006, most federal student loans had a variable interest rate. And in the early 2000s, the interest rates got crazy, crazy low. And one way to lock in that crazy low interest rate was to consolidate your loans and be given this fixed interest rate. These days, although consolidation is still a useful tool in some cases, and I'm going to go over in a minute, most people actually don't need to consolidate. All their loans are most likely already under one servicer, so they're already in one bill. They probably don't need to consolidate to access other benefits that might not be available in other loan programs. Again, there are exceptions we're going to go over, but most people these days, there's no real value in consolidating. Up until 2006, it was possible for a married couple to consolidate their loans together. And this is one of those policies that was the road to hell is paved with good intentions. A lot of the couples that I've worked with that have spousal consolidations, they thought it was a good idea to help manage their household finances. But in fact, Congress ended up getting rid of the spousal consolidation program in 2006 for a reason. And that reason is that spousal consolidations tend to be, especially if there's a financial struggle, fraught with peril. We're going to go into a little more detail about spousals in a second. As I mentioned, consolidation, the term of the loan is based on the size of the loan. If you have anything over $60,000, you're going to have a 30-year term. The shortest term you can get on a federal consolidation is 12 years. Federal consolidation loans are eligible for most, in some cases more, federal student loan benefits. There's no credit check required. Therefore, there's also never a cosigner or an endorser required. You can't, once you consolidate, you can't reconsolidate except in certain circumstances. For example, if you take out new loans, or consolidation is a tool that can be used to help you get out of default. Consolidation, if you've been utilizing deferments and forbearances, consolidation will reset the available forbearance time you have available to you, but it will not. It should not, under law, it should not reset the amount of deferments that you're allowed. I do happen to know, though, that in practice, depending on the servicing system you end up on, sometimes that deferment count does reset. Now, refinancing private loans. In some ways, they're the same. It's the same as consolidation in that refinancing will pay off your underlying loans and create one great big new loan. The term tends to be still 10 years. Sometimes you can find a 15-year refinance, but the interest rates are very different. The interest rates, they can be either variable or fixed, and the interest rates are based on the market rate, and it's based on the borrower's credit profile. Now, the people that tend to get the best deals when refinancing their private loans, it's not just about credit history, and it's not just about debt to income ratio. The companies that offer the best interest rates and the best deals for private loan refinancing, they're looking for the ultimate cream of the crop. So they're not only looking at your typical credit score, debt to income ratio, they're looking at on-time payment history. They're looking at sometimes what school you graduated from, what degree you graduated with, whether you graduated at all. That's not to say that if you have a high private loan interest rate, that's not to say you shouldn't try to refinance. There's some great deals to be had. I'm just saying that the best of the best, they're looking at criteria other than what we're used to. Private loan refinancing does require a credit check, and sometimes, depending on the credit, it will require a cosigner as well. And you can refinance as many times as you can get a better deal. There's no limit to it. Now, you can include federal student loans in your private loan refinance, but we almost never, ever, ever recommend that. In fact, we do whatever we can to try to persuade people against it. And the reason for that is because refinancing your federal loans into the private loan program means losing access to all the federal benefits that you might have available to you, such as income-based repayment options, public service loan forgiveness, discharges due to death or disability. All of those go away and you can't get them back. Once you're out of the federal loan program, you can't go back into it. Let's talk about interest subsidies. If you have federal student loans, chances are you have some subsidized loans and you have some unsubsidized loans. Subsidized loans means that while you're in school at least half time, or in a deferment, or during some periods while it might be under what's called an income-driven repayment plan, the government is going to pay the interest for you. The rest of your loans are going to be unsubsidized, which means that the interest accrues right from day one, and it's always your responsibility. Now, when you consolidate the loans, if you can, anybody who consolidates on or after November 13th of 1997, they're going to, and this is where it can get a little bit confusing if you're looking at your loan records. You consolidate all of your loans, and it's considered legally, and it'll show up on your credit report as a single consolidation loan, and that's what it is. But if you look at your servicer account, or if you look at the Department of Education's account for you, it's going to look like two loans, a subsidized consolidation and an unsubsidized consolidation. While it is still a single loan, they book it in those two parts to make sure that you're still getting whatever subsidies you're entitled to. So, for example, let's say after November 13th of 1997, you have $100,000 in federal student loans. 40,000 of it is subsidized Stafford loans, and the other 60,000 is unsubsidized loans, whether they be Stafford loans or Graduate Plus or even Parent Plus. You consolidate that together. You legally have a single $100,000 consolidation. But what you'll see when you look at the account is a subsidized consolidation for 40,000 and an unsubsidized consolidation for 60,000. Now, as you make payments on that loan, they're going to proportionally assign your payment to those pieces of the loan. So let's say your payment was $100 a month, $40 of it would go to the subsidized portion because that's 40% of your loan, and $60 would go to the unsubsidized portion because that's 60% of your consolidation loan. If you consolidated before November of 97, the only way you would have gotten any subsidy at all is if all the loans you consolidated were subsidized. So if you happen to have an older consolidation, chances are none of it is going to be subsidized because it's very rare for someone to have exclusively subsidized loans. So when is it a good idea to consolidate? As I mentioned before, these days, as opposed to people that had variable rate loans up until 2006, these days there's usually no value. There might not be any harm, but there's usually no value in consolidating. If you already have all direct loans, now this is where it can get a little confusing. Up until 2010, there used to be two primary federal student loan programs. There was the direct loan program and the Federal Family Education Loan Program. And they were both exactly the same, except where they were different back then. In 2010, Congress got rid of the FFEL program, the Federal Family Education Loan Program. And now all we have is the direct loan program. And since then, they've added benefits to the direct loan program that they have not added to the remaining FFEL portfolio. So one good reason to consolidate is if you have old FFEL loans and you want access to some of these new benefits that are only available in the direct loan program. Another reason that it might be valuable to consolidate is that if you have Parent Plus loans that you're struggling with the payment for, or you're pursuing public service loan forgiveness. In that scenario, you need to consolidate because that's the only way to get for a Parent Plus loan to get access to what's called the Income Contingent Repayment Plan, which is the only income-based plan Parent Plus loans can get. If you have the old FFEL loans, or if you have Perkins loans, for example, or maybe some federal nursing school loans that you want to get access to any of the income-driven repayment plans or public service loan forgiveness, that's another reason that you would want to consolidate. You can also use consolidation to get out of default on your federal student loans. Consolidation is always free. Unfortunately, there are a ton of student loan scammers out there, and they will offer to make your life so much easier by consolidating your loans for you, whether you need it or not. And they'll do it for the low price of a couple grand. Do not pay these people. They're a big reason that we founded TISLA, is to make sure that no one ever had to pay if they needed help with their loans. Consolidation is super easy to do if you need to do it. You just log on to studentaid.gov, which is the Department of Ed's website, and you fill out the application. It should take you under a half an hour easily. As I mentioned, The interest rate on a federal consolidation loan is the weighted average of your underlying loans, and then they might round up to the nearest eighth of a point. Do we have any questions so far about consolidation or anything that I've covered? We've got a small group today, so you can just if you either put it in the chat panel or take yourself off mute and ask the question. Okay. All right. So we're in kind of a really unique period for federal student loans. So there's a couple things I want to mention that are unique but for the next couple months only. Normally, when you consolidate a federal student loan, if you've been pursuing forgiveness under either, say, an income-driven repayment plan, which that has a forgiveness component of either after 20 or 25 years, depending on the plan you're on, or the Public Service Loan Forgiveness Program, which forgives the loans after 10 years of eligible payments while working for either an eligible nonprofit or government employer. Normally, if you consolidate, that resets your forgiveness count under all of those things. So let's say you had 30 months of public service loan forgiveness, eligible payments under your belt, and you consolidated, your consolidation loan would now have a count of 0. But this past October, the Biden administration announced some temporary waivers around public service loan forgiveness. And those waivers end October of this year, October of 2022. And during this very limited period, if you consolidate, it will not reset your count for the public service loan forgiveness programs. Now, PSLF is a presentation all into of itself. In fact, we're giving one in about a month. So if you have questions specific to public service loan forgiveness, I strongly advise you to sign up for that webinar, but also check out the PSLF page on our website for more information about PSLF. But I did want to mention that, for the purposes of this webinar about consolidation and refinancing, that one thing you do want to be careful of if you're considering consolidation is that normally, other than this very brief window, when you consolidate, it will reset any forgiveness count that you may already have under your belt for the income-driven plans or for public service loan forgiveness. Now, once you consolidate, you generally cannot consolidate again. There are, of course, exceptions. It wouldn't be federal student loans if there weren't some ifs, ands, buts, or maybes. They will allow you to reconsolidate if you have some additional outstanding loans. So, for example, if you consolidated 2 years ago and have since gone back to school and took out new loans, you would be able to consolidate that first consolidation with those new loans. Or if you didn't consolidate all your loans in the first place, you could consolidate again to consolidate them all together. If you have one of those older FFEL loans that I mentioned before, even if that FFEL loan is consolidated already, you can consolidate again into the direct loan program to get access, as I mentioned, to the income-driven plans or public service loan forgiveness. And the final reason you might be allowed to reconsolidate is that if you have a defaulted loan. In many cases, they will allow you to reconsolidate in order to get out of default. Under the direct loan program, as opposed to the FFEL, there are a few more restrictions to that. Sometimes they make you make a few on-time payments before they'll allow you to consolidate out of default. Sometimes if you're under administrative wage garnishment, they won't let you at all, but it's certainly worth asking about. Now, let's talk about refinancing private loans or even refinancing a federal loan into the private loan program. Now, as I said before, and I'll probably say a bunch more times, we usually strongly recommend against refinancing a federal loan into the private loan program, even if that would mean getting a lower interest rate. And the reason for that is there's a couple things. First of all, and I maybe should have said this up front, we tend to be extremely financially conservative. And part of the reason is that we've been working with student loan borrowers for decades. And unfortunately, we've seen just about every left hook that someone's finances can take that is unexpected. Somebody who is in a very strong position financially, all of a sudden, due to illness or layoff or other economic situations, is in a terrible position financially. And there's no take backsies. Once you refinance a federal loan out of the federal program, you can't go back into the federal loan program. More recently, what I've seen is a lot of regrets from people that have refinanced their federal loans because during this COVID period that started March of 2020, most people with federal student loans have been getting a 0% interest rate and haven't been due for payment. And that has not happened on the private side. And they regret refinancing their federal loans because they lost out on this really valuable benefit. Also, private loans aren't eligible for public service loan forgiveness, income-driven plans. In fact, most private loans don't have any lower payment options, and some of them don't even discharge on the disability or death of the borrower. So if I haven't convinced you yet not to refinance your federal loans out of the federal program, send me an email and I'll try even harder. Listen, if you're a dual income household and you have an extremely robust emergency fund and you could afford to pay the household bills on a single income if something happened, then maybe you should look, and you can get a much lower rate on your loans, then maybe look into it for the federal loans. But otherwise, for the reasons I've given, it's just usually not a good idea. Now, if you have private loans, especially right now, where interest rates are pretty low, it's definitely worth looking into refinancing. Now, some people refinance to get a lower interest rate. Some people refinance to extend the term because they need a lower payment, and the only way to get a lower payment is to get a longer term. And some people refinance because their private loans have a cosigner. And one way to release that cosigner from legal liability of the loans is by refinancing. Unfortunately, what I see is the people that need to refinance the most because they can't afford their payments are least likely to get a good offer, if any offer at all, on refinancing. One tip about getting the best possible offer when refinancing your private loans is to wait. I see a lot of students that try to refinance as soon as they get out of college, and a lot of the big refinancers out there are looking for some on-time payment history. So you usually get a much better deal if you apply to refinance after making 12 or even 24 payments in a row on time on your loans. And again, showing that you are a good risk, essentially. I get asked a lot if I have a recommendation for who to refinance with. And we don't offer recommendations, either good ones or bad ones. And the reason for that is because it's real from a mission perspective. We always want to make sure that we're neutral in the advice that we give. It's also why we don't accept any sponsorship funds from anybody that offers refinance products or let them advertise on our website. So if you were going to ask me who I recommend, unfortunately, I can't tell you. Now, we do put a list on our website in alphabetical order of every refinance opportunity that we're aware of. We update that twice a year. We're about to update it again. If someone's not on there, it's because we don't know about them. If they are on there, it doesn't mean we recommend them. It's just meant to make your life a little bit easier if you're trying to research different refinance opportunities. Frankly, I usually tell people to start with their current lender. The current lender probably wants to keep you in their portfolio, and they may be the most likely to offer you the best deal on a refinance of your private loans. All right, so I mentioned before that I was going to talk a little more about spousal consolidations. If you're one of the people that has a spousal consolidation, what you may or may not know already is that what makes, and these are some of the reasons they stopped allowing spousal consolidations to be made, is the problem with spousal consolidations is that both spouses, even if they're now ex-spouses, have to be eligible for a benefit in order to get the benefit in most cases. So for example, if a deferment is needed, both spouses have to qualify for a deferment for the loan to be put on hold. They don't have to qualify for the same deferment, but they both have to qualify for a deferment, which can make things difficult. What we tend to see is that, my grandfather used to say, he and my grandmother were married for 69 years. And when people asked him what was the secret to their long and strong marriage, the first thing Grandpa would say is, when money goes out the door, love goes out the window. And unfortunately, what we see oftentimes with people with these spousal consolidations is that things didn't work out. There was a divorce, and one spouse refuses to cooperate with the other to sign paperwork for things like lower payment options, or if the loan's in default, a loan rehabilitation to help get it out of default. Spousal consolidations are still eligible for things like public service loan forgiveness, or death or disability discharge. What happens is they just discharge or forgive the portion of the loan that's attributable to the spouse that's eligible for it. The bad news is that, so for example, total and permanent disability. If one spouse was eligible for it and 50% of the original debt was theirs, they would discharge 50%. However, that disabled spouse would still be equally liable for the remaining debt, which is, again, why spousal consolidation was one of those road to hell is paved with good intentions. Now, if you have a FEL spousal consolidation, unfortunately, you can't reconsolidate that into the direct loan program to get eligibility for things like public service loan forgiveness or some of the income-driven plans. They actually used to allow it. They used to quietly allow it, but about 8 or 9 months ago, they stopped. And that's an issue that I'm working on, because there's nothing in student loan law that prohibits it. But so far, I haven't been successful in convincing the Department of Education to change their minds on it. But if you have a direct loan that's a spousal consolidation, you absolutely can pursue public service loan forgiveness and the income-driven plans. So, as I mentioned in the beginning, this is by far our shortest topic. I booked it for an hour just in case, and I have plenty of time to answer any questions that anybody might have about consolidation or the refinance of student loans. And again, you can either take yourself off mute or just put it in the chat panel. Okay, well, let's see. As a reminder, if you do need to consolidate your federal student loans, studentaid.gov is the place to go. If you're looking at refinancing private loans, again, I don't offer recommendations, but there are some aggregators out there that'll let you just sort of punch your information in once, and they'll come back with various offers. Just keep in mind that there's a quid pro quo arrangement between those aggregators and the private loan refinancers. So it's always good to look outside of a single website, look at multiple websites. So the person who said thank you and that the webinars helped them, you're welcome. I'm really glad that it helped. Looks like we do have a question. I have a daughter who has $71,000 in federal loans. Should she consolidate the loans for undergrad and grad? Chances are that she may not need to consolidate. If she has loans that were made prior to 2010, that there's a chance that she has those old FEL loans. And in that case, she probably should consolidate, because it'll open up some more lower payment options for her if she should happen to need them. If she is pursuing public service loan forgiveness and already has some eligible employment history under her belt, because of these temporary waivers, she may want to consolidate. But otherwise, if she has Parent Plus loans, which it doesn't sound like she has Parent Plus loans in her own name, if it's not for those things, then there's probably no value in her consolidating. Now, I see a follow-up that she does work for a nonprofit. If she was working for a nonprofit before she took her graduate loans out, then she absolutely should consolidate. In fact, you should encourage her to log into our PSLF webinar that's coming up in a month, because we talk a lot more about the temporary waivers. But if she didn't start working for a nonprofit until after she finished grad school, then again, there's probably no need for her to consolidate at all. That's good. So there's another comment here saying that this student loan borrower has not made any payments since COVID started, and that's good, because most federal student loans are not weren't due for payment during COVID, have a 0% interest rate, and what was even better is that assuming you were working for eligible employment, those months still count towards PSLF, which is just an amazing benefit that Congress decided to throw in there. I was tickled about it. Okay. Not seeing any other questions, I just want to once again thank Mass Hire from Cape Cod and the Islands for being a partner with us for this webinar. And of course, thanking the Cape Cod Foundation for generously supplying the grant that allows us to do this program with Mass Hire. If you'd like to hear this recording again, stay tuned. We have created a YouTube channel where all of these webinars will go, that should be released in the next 24 hours. So you can see this one as well as the one that we offered last month. And again, please do sign up and tell your friends, your other Cape Cod residents, about the public service loan forgiveness webinar that will be offered in a month. Thank you and have a great afternoon.